Welcome to FXTech's comprehensive EUR USD analysis covering November 3rd through 8th, 2025. This week brought dramatic volatility as the pair tested critical support at 115 amid Fed Chair Powell's hawkish surprise. However, weak U.S. economic data and plunging consumer sentiment reversed dollar strength, allowing the euro to stage a recovery. We'll examine the technical structure, fundamental drivers, and provide actionable trading strategies across multiple timeframes. From short-term sell-on-rally opportunities to the medium-term battle at the 55-week EMA and the long-term significance of the 1.20 level, this analysis equips you with the insights needed to navigate current market conditions. Let's dive into the details. EUR/USD opened the week at 1.15469 and closed at 1.15617, posting a modest gain of 0.13%. However, this small weekly change masks significant intraweek volatility. The pair reached a high of 1.15911 before plunging to 1.1467 on November 5th as Powell's hawkish comments drove dollar strength. The 1.15 psychological level proved critical, with buyers defending the 200-hour moving average at 1.15525. Volume reached 150,090 contracts. Performance metrics show a positive 5-day change of 0.31%, but a 1-month decline of 0.55%. Year to date, the pair remains strong at plus 11.68%. The week's narrative centered on the battle between Fed hawkishness and deteriorating U.S. economic data. 3 critical resistance levels now define the upside potential for EUR/USD. First, the 55-day exponential moving average at 1.1628 acts as the immediate short-term ceiling. Sellers have consistently defended this level, keeping the bearish structure intact. Second, the 61.8% Fibonacci retracement at 1.1591 coincides with a swing high, creating a strong confluence resistance zone. Third, the 1.1573 level, which previously acted as support, has now flipped to resistance following the break below. This role reversal is technically significant. As long as the pair remains below the 55-day EMA, sellers maintain control. Any rallies toward these resistance zones present potential selling opportunities for traders with a bearish bias. On the support side, 4 key levels warrant close attention. The 200-hour moving average at 1.15525 has been successfully defended by buyers multiple times, making it the first line of defense. The major psychological level at 1.15 represents the battleground between bulls and bears. The weekly low at 1.1467 serves as the short-term floor, while a break below would target the 200-day EMA at 1.14. The key technical development this week was the break below 1.1573 support, which opened the path to the 1.14 target. Price remains below the 50% retracement at 1.14919, keeping the bearish structure intact. However, buyers' defense of the 200-hour moving average enabled a recovery toward 61.8% resistance. Fed Chair Jerome Powell delivered a hawkish surprise that shocked financial markets this week. His unexpected pivot cast serious doubt on the December rate cut that markets had been pricing in. The dollar surged to 2-month highs near the 100.00 level on the DXY index as Treasury yields pushed higher. The repricing and interest rate expectations acted as a powerful tailwind for the greenback. Markets were forced to reassess their aggressive Fed easing expectations, with the December rate cut probability falling to 60%. However, a critical development emerged. Despite better-than-expected ADP employment and ISM Services PMI data, the greenback failed to extend its rally. This failure typically signals a short-term top, suggesting Powell's hawkish impact may be fading. 3 key economic releases reversed dollar strength and supported the euro's recovery. First, the Challenger job report showed significant labor market weakness, causing the 10-year Treasury yield to fall 7 basis points to 4.09%. This raised hopes for continued Fed rate cuts. Second, the University of Michigan Consumer Sentiment Index plunged to 50.3 from 53.6, a dramatic 6% decline that brought the index near record lows and nearly 3 points below expectations. Third, the extended U.S. government shutdown created market uncertainty, causing the USD index to slip to 99.53. Despite strong data early in the week, the greenback's failure to extend its rally signaled a short-term top, allowing EUR/USD to recover above 1.15 by week's end. The Eurozone provided positive support for the euro this week. The HCOB final composite PMI rose to 52.5 from 51.2, marking the fastest economic growth since May 2023. This acceleration in economic activity supports the ECB's current policy stance. Core inflation remained stable at 2.4% year-over-year, above the ECB's 2% target, but within an acceptable range requiring no immediate action. The European Central Bank maintained its steady policy stance with no rate changes, with policymakers emphasizing that current policy is appropriate, and they won't respond to small or short-term deviations from their 2% target. However, an important caveat, France proved to be the biggest drag on the bloc's economy, highlighting divergence within the currency union. For short-term traders, a bearish scenario offers the best risk-reward. The primary strategy is to sell rallies toward the 1.1576 to 1.1628 resistance zone, targeting 1.1500 initially and 1.1390 as a secondary target. Place stops above 1.1650 for a risk-reward ratio of 1 to 2. The rationale: sellers maintain control below the 55-day EMA at 1.1628. The break of 1.1573 support opened the downside path, and the 50-day EMA is drifting lower. For higher-risk traders, a counter-trend long strategy involves buying at 1.15 or 1.1497 on a bounce, targeting 1.1580 to 1.1600, with stops below 1.1470. This offers a 1 to 1.5 risk-reward, but is predicated on continued buyer defense of psychological support. The medium-term outlook hinges on the 55-week exponential moving average at 1.1306, the critical pivot that determines if the uptrend from the 2022 low remains intact. The bearish scenario carries a 60% probability. A break below 1.1467 followed by a decisive break of 1.1306 would target 1.1390, then 1.14, and ultimately 1.1250 to 1.1300. Bearish divergence in the daily MACD suggests a medium-term top at 1.1917. The bullish scenario has a 40% probability. If 1.15 holds firmly and the pair breaks above 1.1628 and 1.1727, targets rise to 1.1750 to 1.1800 and potentially 1.1917. Critical factors to monitor include the December FOMC meeting, government shutdown, Eurozone Q4 GDP, and U.S.-China trade talks. The 1.20 level represents the ultimate battleground for EUR/USD's long-term direction. This level, the 38.2% Fibonacci retracement of the entire decline from the 2008 high at 1.6039 to the 2022 low at 0.9534, will determine whether the multi-decade downtrend continues or reverses. Currently trading at 1.1562, the pair remains well below this critical barrier. If 1.20 rejects, the multi-decade downtrend from 2008 remains intact, potentially leading to a retest of 0.9534 or new lows. If 1.20 breaks decisively, it signals a long-term bullish reversal, with the 61.8% retracement at 1.3554 becoming the next major target. The first test comes at the 55-week EMA at 1.1306, which must hold to keep the path to 1.20 open. Successful trading requires disciplined risk management. Follow 3 core rules. Never risk more than 2% of your trading capital on a single trade. Use strict stop losses on every trade without exception, and target a minimum 1-to-2 risk-reward ratio. Monitor these key events: the December FOMC meeting for rate cut expectations, US NFP and CPI data determining Fed policy, government shutdown resolution affecting USD sentiment, Eurozone Q4 GDP for growth sustainability, US-China trade negotiations impacting risk sentiment, and ECB policy statements. Strategic takeaways: short-term bearish bias below 1.1628, medium-term pivot at 1.1306, long-term significance of 1.20, and always maintain strict risk discipline. Trade smart, trade safe. Thank you for watching FXTech's Euro to US dollar analysis.